What's going on, traders? Welcome back to another video. This one is going to be about the internal range liquidity and the external range liquidity. So let's start with the introduction. The internal to external and external to internal range liquidity are important because the price is always transitioning through them, and it is building that narrative where price is going towards and from where is it going. The internal to external range liquidity is obviously the retracement into expansion phase, in which the price is retracing into that fair value gap, that imbalance, and then seeking all highs or lows. And on the other side, the external to internal range liquidity is a reversal into expansion phase. The market is always seeking two primary objectives. It is all highs and lows, also known as liquidity pools and imbalances, fair value gaps for efficient price delivery. The first one is the IRL to ERL, the internal range liquidity to external range liquidity, also known as the retracement into expansion phase. This phase of price delivery occurs when in a trending market, the price is retracing towards the fair value gap, then followed by an expansion to the external range highs or the range lows. The IRL to ERL is a high probability move because you are aligning yourself with the trend. As you can see in this schematic, we are in a bullish order flow and a bullish trend. The price expanded, then retraced into the internal range liquidity, followed by expansion to the external range highs. The protocol for trading the internal to external range liquidity is you have to identify the fair value gap in the price section. Then you have to wait for the swing formation inside that fair value gap. Then a reversal confirmation, which is the change in state of delivery. Or also you can add an SMT divergence for the confluence, and then you will be executing trades. Now in this schematic, you can see we tapped into the internal range liquidity, that fair value gap. Then on the lower time frames, that reversal signature occurred, change in state of delivery, down close candle followed by a closure above. So when the price is transitioning through phases of price delivery, it will follow that reversal signature, that change in state of delivery, and that is how you can confirm a fair value gap. Like people often ask why this fair value gap should hold. You have to simply wait for a swing formation inside that, trade the second candle with change in state of delivery, or wait for the third expansion candle towards the external range highs. Now we will go over some examples of the internal to external range. So here we are with our first example. We are on the gold futures daily chart. We have a candle to closure, a swing formation on the daily chart, and also we have an SMT divergence with the silver at these lows. Now we don't have that internal range liquidity on the daily time frame, so we will drop down to the 4-hour chart. And our bias for the next day is bullish. On the 4-hour chart, you can see we have SMT divergence, candle to closure, a change in the state of delivery confirming the reversal signature. Now all we can do is wait for an internal range liquidity on the 4-hour chart, then trade an expansion to the upside. Now with the 10 AM candle, we tapped into an internal range liquidity, which is this fair value gap, so I will mark that out. Now currently our external range high is this high, or we can target the extreme range high. Now dropping down to the aligned time frame, we need a change in the state of delivery or SMT divergence to confirm that reversal. This is 4-hour chart, so I will drop down to the 15-minute. Here on the 15-minute chart, you can see this is our external range high, the target, and this is the internal range liquidity, which is the 4-hour fair value gap. Now we need the change in the state of delivery, and as you can see, relative to the 4-hour opening, we are creating the low of the 4-hour candle. We need a closure above the down close candles or the single down close candle. Now we have closed above the down close candle. Now I can put my limit order on that order block, my stop below this low, and targeting the external range high. And here for the confluence, we have an SMT divergence with the silver, the bearish SMT divergence, but our daily time frame is bullish, so I'm trading gold. And we have expanded towards the external range high. This was the example of 4-hour internal to external range liquidity. We had a shallow run below the previous candle low, the indication of the expansion candle, then open low high close candle. From that fair value gap to the external range high. Now in this example, I will show a trade which I took on 31st of January, which was a market maker buy model of 4-hour internal range liquidity to external range liquidity. Now starting with the daily chart, we are in a bullish order flow. We closed above the down close candle, so it means we are expanding to the upside. We don't have that candle closure. So from that point onwards, I would drop down to the 4-hour chart. Now on the 4-hour chart, we are in a bullish order flow. Now in the New York session, we tapped into this fair value gap, this internal range liquidity. Now we need is an expansion candle to the upside. So I would drop down to the aligned time frame, which is the 15-minute chart. Now here on the 15-minute chart, we have taken these lows and we take the internal range liquidity. All we need is a closure above the down close candles. Now first we have this order block, but we had news that day and I'm trading post news, so I would wait for a continuation entry. Now we have closed above the down close candle, and also we have an SMT divergence with the silver right here. Now all I need is a continuation entry to get inside with the distribution. And here we have tagged that entry and we expanded to the upside, which is the external range liquidity. So this is the example of the trade that I have taken, and I will add this screenshot on the right side. A 4-hour internal range liquidity tag, a change in the state of delivery confirming that with SMT divergence is a confluence, and then trading the expansion with the continuation order block. And also, as you can see, the 10 AM candle also created that lower wick, open, low, high, close, and expanded to the upside. Another example of trading the internal to external range liquidity. Price has retraced into the internal range liquidity pool, this 4-hour fair value gap. And another thing you can see is we have a candle 2 closure and a 6 AM reversal. So that means that 10 AM will be an expansion candle. And also we have a low resistance liquidity run, a failure swing on the upside. So from this point onwards, I would drop down to the 15-minute chart. So here on the 15-minute chart, we are inside that 4-hour fair value gap, that internal range liquidity pool, and we are trading towards the external range liquidity pool. This is how the IRL to ERL is giving you the narrative of the price section. We have equal highs above here, and this is the 6 AM candle, 6 AM reversal, so the 10 AM will be an expansion candle. We have a change in the state of delivery after taking these stops, a series of down close candles. Now I can enter with the next candle, my stop loss below the body lows and targeting the range high. And as you can see, we have expanded to the upside, completing that market maker buy model. Now the external to internal range liquidity, also known as a reversal into expansion. This failure price delivery is a counter trend move because you are trading against the prevailing trend. The price is seeking a fair value gap to then trade back to the external range highs. This is a counter trend move because the expansion is always larger than the retracement. The protocol for the external range liquidity will be you have to wait for the swing formation at the external range highs or lows, then change in the state of delivery and a continuation entry. So here is the schematic. We are trading that counter trend move towards the internal range liquidity, the swing formation at the highs, ERL, then trading it to the downside on the lower time frame. When we are reaching that ERL, we have to wait for a closure below the up close candle, that change in the state of delivery on the aligned time frame, and then followed by expansion to the downside. Now we will go over some examples of how to trade the external to internal range liquidity. Now in this example, we will cover the external to internal range liquidity move. Trading against the prevailing trend. We are clearly in an uptrend. Down close candles are supporting the price action. We are trending to the upside, but we will try to catch that external to internal range liquidity move. So first, our target is this fair value gap, which is the internal range liquidity, and we want to trade that swing point at the highs to trade it back towards the fair value gap. Now I will drop down to the 4-hour time frame to trade that 4-hour to 15-minute market maker model. Now this internal range liquidity is our target, and we have manipulated this range high, that sweep up that high. So on the 15-minute time frame, we would wait for the change in state of delivery to trade it to the downside. On the 15-minute time frame, we have swept the external range liquidity, and we would wait for the closure below the series of up close candles. Now with the next candle, we got that closure, so I would enter on the next candle my stop above the body highs and targeting the internal range liquidity R2R. It took a long time, but eventually we have had our internal range liquidity target. So this was the example of trading the external to internal range liquidity move, that counter trend move. I would not suggest this move myself because it is like catching the reversal. The internal to external range liquidity is the high probability move because you are aligning yourself with the trend. This is it for this video. This was the part 4 of building the foundation video series. In the next video, we will cover the order flow and the daily buys. And in the last video, we will build a model using all these concepts. Thank you guys for watching. Make sure to subscribe to the channel and like the video, and see you in the next one.